to this computer. We're recording. Okay. All right, so I think we're ready to go.
All right. Well,
okay. Good morning, everybody. This is the presentation for Thursday, the 25th. This is actually I'm re-recording this because we had some issues getting all of this captured for whatever reason. We think the computer kind of glitched out on us. Just had a long discussion with IT, and I'm very sorry that we keep bringing this whole thing up, but nonetheless, I did want to record a video that went over at least probably the first third of chapter 4, and so that we get a good start in this. My plan, if we take a look at the syllabus, as I've said before, that what I did was I defer the due dates for the activities for chapters 2 through 4 by 1 week each. Next week we have our first exam, and so the chapter 4 content will be due that same week as well. And so what I'm just asking everyone to do is sort of, pace yourself, make sure you don't wait till the last moment in order to do the quiz homework. And well, of course, the quiz is due the Friday before the Sunday due date, but I would not wait till the last minute to do homework and exam. I think it's going to be a little bit too much. So, but it's up to you how you want to do it. When I change due dates, I do it, as I think I mentioned before, to be in your advantage. I want to give you more time as opposed to less, and that way you are able to get thoroughly familiar with the content and are in better shape in order to take the exams and do the other activities. Okay. All right. So let's talk about chapter 4 and what chapter 4 is all about. So in chapter 3, which we didn't quite get all the way through, I was planning to do a supplementary video there just because of the fact that class time ran short. But chapter 3 dealt with the balance sheet, and here we're going to talk about the income statement. We're going to talk a bit about comprehensive income. Probably not in this particular video. Comprehensive income will come a bit later, and the statement of cash flows will come probably in class next week. But I do want to talk mostly about the income statement here and talk about the various pieces of it, including those things which are a little less common, such as things like discontinued operations, restructurings, impairments, things of that nature. And so we're going to get into those topics and go from there. So it's a little bit of a deeper dive, I think, into this particular statement than what was presented in Accounting 2110, or what we sometimes call Principles 1. So we're going to take a little bit more of an in-depth look as to what is happening with this. So let's talk about the income statement. Let's kind of get into it and talk about what the various elements are that we should know about. And in this particular chapter, we are going to talk about the income statement. We'll talk a bit more about comprehensive income. And I think I gave you some examples. This actually came up a bit in the prior segment of the class, where we talked a bit about what comprehensive income was, and in particular, the idea of whatever comprehensive income is incurred in a particular period accumulates and is therefore, credited over onto the balance sheet under retained earnings or statement of shareholders' equity, I should say, and it's what we call accumulated other comprehensive income. And I'll talk a bit more about comprehensive income, which is an income statement item, and or actually is an addendum to the income statement, sort of separately stated typically, and then accumulated other comprehensive income, which is a balance sheet item. Remember, balance sheets are these snapshots. And then the statement of cash flows, which is something we didn't really cover too much at all in Principles 1. I think it's a little bit beyond the scope of what we were trying to accomplish there. And we'll talk about the nature of this particular statement, which is more important than what a lot of people believe. It tells a lot about the sources and uses of cash throughout the accounting period, broken out by the 3 main business activities of operating, investing, and financing. So we'll get to that before we end this particular segment of the class. When we talk about an income statement, this is just a generic example here. McAllister's Manufacturing, hypothetical company, and I'll try to blow it up a bit. I know that sometimes these are hard to see in video on screens, particularly if you're looking on a cell phone or iPad or whatever. But nonetheless, these are also captured in the text. So what do you have here? You've got this first section is income from continuing operations, which looks in the beginning a lot like what we have seen before. Sales minus cost of goods sold equals gross profit. Okay. And then we have these these other costs, which are non-product costs, selling expenses, general administrative, etc. We do have something called restructuring costs, and we'll come back to that in a second. But these are all operating expenses. Then we have something called operating income. And then everything really below that are non-operating items and things like interest revenue, interest expense, gains or losses on things, sales and investments or assets, or any kind of a disposition that creates either a gain or a loss. And we'll talk about why that's a non-operating and why that's important and why it is preferred to sort of break that out from operating expenses. Notice operating income is sometimes called earnings before interest and taxes, or EBIT for short. Sometimes you might see this being reflected as what's called EBITDA, earnings before interest, taxes, depreciation, and amortization, if the particular analyst wants to present it in that particular way. And again, users of financial statements can do whatever they want with the statements. They can slice them and dice them, chop them up, and make them, suitable to whatever their particular purposes are. And then notice that after we get to the gains issue, we have income from continuing operations. We have the tax effect on that, in this case, a tax expense, and then we sort of stop with income from continuing operations. If there are discontinued operations, and we'll talk more about what some examples are of discontinued operations and what's going on, then we'll recognize any gain or loss. And we'll get to the peculiarities of how we actually do the reporting for discontinued operations, any kind of income tax effect, and then we have net income. And then the final piece here is really sort of an addendum. It's really not necessarily related to the income statement, although it derives its information from that. It's the idea of net income divided by average number of shares outstanding. Usually the numerator is net of preferred dividends, if you want to do it that way. But again, you are free to do it however you like. There's no set standard because the ratios really aren't necessarily GAAP compliant. I mean, people use financial ratios for all kinds of different purposes, and so earnings per share is simply one of those. All it really is simply total income divided by number of common shares, and that's really all that's going on. And earnings per share, I'm going to tell you, I think it's a little bit difficult to translate unless you really know what the price per share is at currently, what the expectation is that management has set for earnings per share, what the history has been over time. Because companies will report earnings like on a quarterly basis, and they'll say we earned 67 cents a share. Well, what the heck does that mean, right? I mean, unless you really know what the price per share is and what the expectation is, the forward guidance that is given, it doesn't really mean that much. But it does in the context of all other facts that need to be taken into account. So net income then is simply taking these common shares and presenting earnings on a per share basis. Okay, again, it's mostly meaningful when compared to other sorts of issues. Okay, one other thing, this is something that I hesitate to bring it up, but just to make sure everyone is completely on page here about the omissions of zeros. This is dollars and millions, so it's not 1,400 in revenue, it's 1.4 billion in this particular case, and so we've taken out 6 zeros, so we're presenting these in millions, and so just kind of be aware of that. And it's done just to sort of condense this information to make it easier on the eyes to see. If any user wants more specific information as to the precise dollar figures, you can drill down into the notes usually, or supplementary schedules, which are which proliferate this reporting in public company reporting, and you can actually get those numbers if you want to see them, and many people do want to see them and want to know what are the components of these. How were these numbers arrived at? And this is really the job of financial analysts, many of whom are in the financial community, particularly in the investment world, just trying to figure out what's happening with the companies that they follow. Okay? All right, so we talked about continuing operations. What are we really getting at here? Well, first of all, the big issues, and this is pretty basic, is revenues and expenses and what's going on here during the reporting period, which is either a quarter or a year. I think I may have mentioned last time that there's a proposal to do reporting on a semi-annual basis as opposed to a quarterly basis. And these are still early days. I guess we'll find out what happens. But certainly from a quarterly as well as an annual basis, companies report this information. And obviously from an income statement perspective, which is what we're focusing on here, revenues and expenses it doesn't get much more basic. But revenues reflect the value of outputs. It's essentially what's going on. We're creating a product or a good or service for sale, and so the value of those that we have transferred to buyers or revenues and expenses are those things that it took for us to do what it took to provide those goods for sale. We try to match those up within the same accounting period. They represent the value of those inputs, labor, materials, overhead, all those kinds of input costs, which represent the value of the efforts produced in order to produce the particular output. So this is, once again, fairly straightforward, I think, fairly basic, but nonetheless is an important element of what we're trying to express here with regard to reporting. Okay. All right. Let's move on here a little bit and talk a bit about expense recognition and what we're doing with that. This is a little bit difficult to follow. I don't know that this is probably not my favorite graph in the text, but we talk about the causal relationship or the matching up relationship. If revenues and expenses are, if we can establish this causal relationship, that is, these expenses were incurred to produce these revenues, then it's fairly simple to sort of match these up. Or maybe simple is not the right word, but at least it's straightforward as to what we're trying to do, right? If they're not, they probably relate more to what we call period costs. And those are expenses that we simply allocate to a particular accounting period. We either allocate it over several periods, depending upon what the cost is, what the nature of the cost is, cost or expense. So the term is terms are used interchangeably, or we expense it as incurred. It really depends on what is going on. So one of the things I don't think if you took 2110 here, principles 1 here, I don't think we really got into very much discussion about what we call the matching principle, where accountants try their best to match up revenues and expenses in the periods in which they're incurred. And again, in an accrual accounting setting, we're not interested in when the cash changes hands, but when these events are incurred, when the revenue is earned and when the expenses are incurred. And that's what we refer to as revenue recognition and expense recognition, respectively. Okay. And when we talk about continuing operations, we also have to know there are these things called gains and losses. And these are things that are outside of the normal operating reporting. They do not get included in operating income because they are, and I like the way that this is phrased, peripheral incidental transactions, such as the sale of an asset at a gain or a loss, or any kind of disposition. We think of dispositions as being any kind of a firm getting rid of an asset, often through sale, but it could also be a loss. It's destroyed, or it's an insured loss, or the asset is quickly becoming obsolete, whatever the case might be. We recognize a gain or a loss. Now, why are these non-operating? They're non-operating because we're not in business of taking gains or losses on incidental transactions. Even things like we have bought stock as an investment, we sold it. We bought a $15 share, we sold it for $18 a share. We have a $3 per share gain. That's not, unless we're in the business of buying and selling stock, that is just simply a incidental transaction. It's away from the main activities of the business itself. And so all kinds of reasons can create gains and losses. And I think in Intermediate 2, we talk a lot more about gains and losses and what to do about them and how we do the reporting for them. Okay? All right. This is kind of a busy example, sort of boxed out section here where we talk about the operating activities where, again, this is back to the McAllister Company, sales minus cost of goods sold equals gross profit. Again, these are all dollar figures. Gross margin is usually the percentage of gross profit in relation to sales revenue, but gross profit is the dollar figure. And those are the product costs, cost of goods sold of product costs. It's what it costs to bring that good to market. All kinds. If it's manufacturing, we probably have all kinds of costs like, inventory, raw materials, and all these things which go into the actual product cost itself. Labor and overhead and all those kind of things are captured within that. But once we have that top section done, then we get into some of the operating expenses, selling expenses, which are, can include a lot of different things, advertising costs, sales commissions, things of that nature. General administrative costs oftentimes are very, very high in relation to total expenses overall. R&D and restructuring costs, we'll talk a bit about restructuring in a minute. And then see total operating expenses. And then obviously you simply are deducting these costs as you go down. So we have operating income, in this case, of $166 million. Okay. And then we have the non-operating items, which again, this is a reason why we call this EBIT, earnings before interest and taxes, is because interest and taxes haven't been included yet, but they will be. Interest income and interest expense, both. And then any kind of a gain on sale, which again, this happens to be a gain, it could be a loss, doesn't, I mean, however it goes, right? And then you have income from continuing operations before taxes. There's a tax effect. We'll talk a bit about that. I don't like to get too deeply into the tall weeds of tax, but nonetheless, we should know that there's an income tax effect as we report income, and that's simply just the nature of corporate taxation. So then we have income from continuing operations. Okay, this sort of assumes that there's going to be some discontinued operations and whatnot. So we would have to sort of take that into account, and we don't know what those are, but nonetheless, those are realities that will come further down on the income statement. Quick look at Home Depot from January 29th, 2017. Again, a lot of retailers pick on a year end that sometimes captures any kind of holiday sales. I don't know how much Home Depot is seasonal in the sense of holiday sales, but nonetheless, it's not unusual for retailers to pick some January year end. So in this case, it's January 29th. And we have the same kinds of breakouts here. Notice we have depreciation and amortization being broken out there. So we have operating income, and then the non-operating items, the income tax effect of those, which is basically whatever the percentage of tax is that applies to a public company, which we call a C Corp. And I think the rate that is applied in this chapter is 25%, even though it's actually 21%. That's neither here nor there. It's just for example purposes. And then we have net income. We have a double line underneath that. So whenever you see the double line on a statement, anywhere in accounting, it's usually telling the reader the statement is done. We've reached the quote unquote bottom line, right? All right, so there are other alternative methods. This is one that I don't think is too much in favor. I certainly am not a big fan of it. It's a single-step income statement where you certainly group the inflows and the outflows together, including operating and non-operating items together. We have sales, interest, revenue, which is a non-operating item, gain on sale, which is a non-operating item. But you're grouping the inflows and you're grouping the outflows together. And this is not really the preferred way of doing it, because I think most users would expect to see a breakout between operating and non-operating results, but nonetheless, this is a fairly easy way of producing it. We don't see a lot of that. It's not something that we really favor in the accounting of financial world. Instead, a multi-step income statement is what is preferred, where we have the operating items of sales minus cost of goods sold equals gross profit. We have the operating expenses, which are related to the day-to-day operations of the business, hence the term. And we have operating income. So from here on up is the operating income and operating results, we should say. And then everything below this, up to this point here, are non-operating items. Interest revenue, it's an incidental inflow into the business, a gain and sale. Interest expense, which is obviously going in the other direction. And we have total other income, income before taxes. And we have income tax expense, which again looks like it's 25% is being applied. And then we have net income. And this is what's interesting about this, and this is why it's preferred, is that we use subtotals. And subtotals are used everywhere in accounting and presenting statements, whether they are GAAP prepared statements for external users like this, or whether they're even internal statements, like what we covered in managerial accounting, where you may have all kinds of different categories and all kinds of subtotals, all of which sort of flow to the right and down, and that's essentially what's happening. Just think of it as a stream going downhill. And but the subtotals are important in order to allow the user to ascertain what might be happening, and it's an important breakout. Okay. All right, and let's talk a bit about earnings quality, which is the next topic, and I think that the text sort of meanders around here when we talk about different topics, and but when we talk about income, which is the subject of this first part of this module, we're talking about something called earnings quality. And earnings quality may not be a term familiar to a lot of people, but it's something that's on the mind of a lot of CFOs and accountants and top management. And that is, okay, we've got earnings, but how permanent are those earnings? How reliable are those? And how do we express to users that some of these earnings are temporary and are not likely to be repeated, and therefore we shouldn't look to them to be continued going forward. Now, one thing I'll say is this: if you go back to if you do 2120 here, which is managerial accounting or principles 2, we talked about so-called one-off transactions or special transactions, special pricing, special orders, and do we do it? Do we not do it? Sometimes companies are faced with a rush order from a customer they don't know, but they decide, do I want to do it or do I not want to do it? But it may not be a repetitive thing because this is not perhaps an ongoing customer and there's really no relationship. It's more sort of transactional. And so in that case, we would sort of view that more as temporary earnings. That doesn't mean that the company should decide not to do it and only deal with those customers that management feels is going to be of a permanent nature, because we make the case, a very strong case, I think, in principles 2, that if it makes sense to do it and it adds incremental income and without any kind of addition, usually without any kind of addition to things like capacity or equipment or fixed assets or even labor increases, if it makes sense to do it, why not do it? But those are not really permanent earnings in the sense that these are sort of one-off transactions. And so they're not ongoing and they really should not be considered part of continuing operations. Okay, so permanent earnings are those that are likely to continue to generate similar profits in the future. Now, interestingly enough, companies are always worried about losing big customers in particular. Obviously, losing smaller customers is less of a crisis than losing a bigger one. I think that goes without saying. But when that happens, though, that has a material impact on earnings quality. And so as a result, companies will disclose when those kinds of events happen. And they're obviously not good events, but they do happen. And so that's just part of the fabric of the business world. Okay. Also, we talked about income smoothing. Again, we're sort of meandering around a lot of these topics, sort of hitting some of the high points when we talk about income statement, income reporting. And there's a concept known as income smoothing, and it's allowed within GAAP accounting, as it's indicated here. But what it really is management's effort to sort of even out income over time by sort of managing expenses in particular. And it's, as your text notes, it's controversial. And I suppose if it's done in a way that misleads users, then it's a real problem. But if it's only intended to sort of shift costs and even sometimes revenues from one accounting period to the other, it's maybe just something to be expected. I can tell you that when I was my first couple of jobs out of college, I worked for public companies, and the first couple of years I was sort of in middle management. I would get a call. We were at December 31st year in. I'd get a call sometime early December from my boss saying, "Hey, we're tearing it up. We're meeting our earnings expectations. We're blown out of the water. So if you have anything that you need to spend money on here before the end of the year, let's do it. Whether it's if you need to send somebody to training, you need to get licenses renewed, you need something repaired." No, they didn't. I mean, they weren't interested in doing things like sending everybody to the Bahamas for Christmas or whatever. But they would say, let's get this in this particular accounting period because we are doing very, very well. And if it's something that we would have paid for next year, the year after, whatever, let's move it up. Let's get it done now so we can get there. Okay. It works in the other direction as well, where if a company is not particularly doing great, in a particular accounting period, they could defer certain expenses, things like maybe training expenses. Travel is a big one. Business travel could be curtailed very dramatically. Advertising is sort of a classic example of a cost which can be turned off fairly quickly. So business travel, cutting that out or reducing it, and also things like cutting out advertising. They may not be great for the long-term revenue outlook, but they certainly do a lot for income, at least in the short run, by reducing those costs really quickly. And income smoothing is one thing. It sort of then begs the question of whether or not the company is now leading into what's something called earnings management. And earnings management is a term in accounting that sounds pretty benign. It sounds like it's just part of the normal course of doing business, but it's really got a negative connotation because what it suggests is that management is trying to manipulate earnings by doing things to their particularly the cost structure in order to boost earnings or to whatever. And And so it does not have a particularly a good reputation. So, but it's out there, and these are things to think about. And it's not always obvious when these kinds of things are happening. And but nonetheless, it's something to think about for those of us who are looking, for those of you who are looking to go into the business world, particularly in a public company setting where earnings are reported to the public. Does it become an issue? Okay. All right. So we talk about temporary earnings versus the more permanent earnings or continuing operation earnings from continuing operations. What are temporary earnings? Well, they're A, earnings from transactions that are not likely to occur again. Yeah, that makes sense. B, earnings from transactions are likely to generate similar profits. No. C, earnings from transactions likely to have a different impact on income in the future, which is the case, yes, because it's not probably going to be around. So the answer is A and C, and that is temporary earnings are those things which cannot necessarily be counted upon going forward, just simply because of the nature of the business relationship and how that comes about. And sometimes it's not always clear what is a temporary earning, what is a permanent earning, particularly when you're a business that does lots of transactions with companies that may or may not be repetitive in nature. And it becomes something of a challenge, particularly if you're dealing with consumers, because a lot of consumers, it's really hard to sort of say this is a permanent consumer, that is not. But certainly in the business to business scheme of things, it's a little bit more concrete. Okay, now we get into here a variety of special occurrences that have to be accounted for separately on the income statement. We've got a very partial statement of Hershey as for the year end, December 31st of 2015, and then also for 2016. You have sales, cost of sales, you have selling, marketing, administrative expenses, and so obviously this is very much abbreviated. You've got some things like impairments, and we're going to talk about impairments in a minute. Realignment charges, which could also be called restructuring, and so you have operating profit. So we're going to sort of get into a bit of a list of different kinds of items that have to be reported on the income statement and why they have to be usually separated out because they are not really part of the normal scheme of things. And so one of these is restructuring costs. Let's talk a bit about what these are. It is not unusual for companies to say, you know what, we are going to change our focus, our strategic focus, and we're going to exit a particular line of business, or we're going to spin off part of the business or all the business, or whatever the case might be. But any costs associated with it will obviously change the scope of operations. And when we know that they're going to happen, when management determines that these are things that are going to happen, usually coinciding with board approval of these are things that usually go to the board of directors, and the board said, okay, we're going to exit, we're going to, we make shampoo and conditioner, we're going to stop making conditioner or whatever. And the board says we're going to do that. That's when we are recognizing the fact that we're going to restructure to get rid of that. And then any kind of benefits payable to employees, for instance. Yes, a lot of times these are associated with layoffs, and it's obviously a very negative occurrence, particularly for the one being laid off. And there are costs associated with that, sometimes severance, payout of benefits, all kinds of things that are personnel related in that regard, but also other kinds of costs, like what does it cost to close facilities, to sell them, to do whatever it is that we're doing with them. Restructurings happen a lot, and particularly in bigger companies, publicly traded companies, where companies decide they're doing one thing, they decide that they want to refocus and restructure things. When I was in the banking world, I didn't have any personal involvement. We had an indirect lending operation that didn't go very well. It was lending through the car dealers. If you heard about a car before, they want to set at a dealer, which I imagine most of us have, they want to set up the financing there on their own because they get a piece of the action, and we just never could make it work. And we terminated that activity. It was pretty expensive to get out of it, actually, with all the people who were involved, but nonetheless, that happens. My sister worked for a drug company once that, if you know anything about the drug industry, you kind of know that there are really fat margins. That is the difference between sales price and unit cost. They're among the biggest margins in the economy, really. And so at one point they decided they wanted to diversify and find some other high margin item or some other high margin business to get into. And so they chose to get into cosmetics, and that didn't go very well. And only a few years into that, they decided, you know what? It's one thing to be able to make, antibiotics and antidepressants and cancer drugs. It's another to make cosmetics, and it didn't work, and they just didn't know what they were doing. And so as a result, they had to terminate that. My sister was working there at the time, and it was the financial community was not amused by that at all. I can tell you, they thought that was a particularly silly thing to have done, and I think the CEO actually got replaced at some point, not long after. Maybe it was because of that or not. Who knows? But you kind of get the idea that sometimes companies get into things and decide it's just not for us, right? All right, so we talked about earnings quality. What are some other items that what your text refers to as unusual items? Well, asset impairments, and they can affect tangible assets like equipment or buildings, even lines of business, or intangible assets that can also become impaired. Things like you may have a patent on a particular process or product that somehow is now obsolete, so there's an impairment of that. And we have to reduce the asset value once we know that there's an impairment that's been incurred. And impairment losses in the test that I think we get into a little bit later as to what the accounting treatment is for an impairment. But companies are on the lookout for impairment losses, and both FASB as well as the IASB, the International Accounting Standards Board, require companies to do tests for impairment to make sure that assets are being reflected on the balance sheet at a correct amount. But how does this affect the income statement? Because there's a reduction, there's a cost associated with the impairment. It's taken at the time that the impairment is recognized. Also, other things that affect earnings quality, we sort of talked a bit about this a second ago, losing a customer that is unable to be replaced easily. Misstatement of revenue, any kind of premature revenue recognition. We think of premature revenue recognition. I know that we sometimes I think our minds go to the more extreme cases, MCIs being one of those where they were sort of advancing. I think also Enron was really advancing revenue that really hadn't yet been earned, but they wanted to book it in that early on in order to record the revenue and record the income and boost retained earnings and all that. But that is an issue of earnings quality. Can you really do that? I mean, does that make sense to do? And so sometimes, well, it doesn't make sense to do premature revenue recognition, but the question is, when do you know that it's happened and all that? So that's kind of an item that does affect earnings quality. But also non-operating items. Again, non-operating items are these things which are tangential to the core business, that is interest, income, or expense. And those are all non-operating items, which is why I tend to break those out on the income statements so that users can see what is related to operating, what is related to non-operating, things like gains and losses, interest, and all that. And then taxes come down toward the end, but when it comes to discontinued operations, we'll break taxes out separately on those, as we'll see here in a minute. So the partial income statement here, you get the idea. This is a very abbreviated income statement. We have operating income, then we have interest and investment income. It's a positive figure. Interest expense, a negative. It's a cost, obviously. Then we have income before taxes, and that kind of gives you an idea of the idea that we do want to break these events out. Okay, and then let's talk about non-GAAP earnings. This is the area that it's always a sort of a source of controversy. There are and it's got a lot of different elements to it, some of which I think are going to be a bit beyond where we want to go here. There are cases in which companies will report on particularly on a quarterly basis, non-GAAP earnings, and meaning that they don't necessarily adhere to all the GAAP standards for all the things that we have to do in terms of GAAP accounting treatment. And so they simply refer to it as non-GAAP earnings, and they're less reliable. They're less their items are less prone to just simply taking the company's word for it, and that certain things are not included, things like restructuring costs, any kind of write-downs of impaired assets. And there are cases in which I hate to sort of keep harping on the issue of companies that are sort of playing maybe fast and loose with accounting, but this is the world in which we live in, particularly since the Sarbanes-Oxley Act of 2002, where there are a lot of companies doing a lot of sketchy things, and so it is important to make sure that they're not doing that, including, are they writing down impaired assets? And there The accounting literature is actually, the academic literature is actually quite full of examples of companies that have really held off on recognizing impairments to the point where even CEOs and CFOs are trying to convince the board, we don't want to write these assets down just yet. Let's just hold on. Let's not do it and whatnot. And because it might be a fairly big charge against earnings, and that's not what they're paid to do. They're paid to create earnings, not reductions in earnings. So, but they do happen, and so it does happen. And again, the slide indicates they're controversial since they're at the discretion of management, and this is obviously an issue that comes back to corporate governance, and it's something that is always a thing to consider. Is management reporting these impairments? And impairment is simply sort of a damage to an asset. Does it have the ability to generate earnings? And the test of that is a little bit arcane. But we'll talk about the treatment here in just a second as to that. So, okay. Before we do that, though, let's talk about discontinued operations. So we sort of alluded to this, and so when we talk about discontinued operations, we're talking about an enterprise that wants to get rid of a part of their business. Maybe it's a division, maybe it's a particular product line, maybe it's a region they're doing business in, whatever the case might be, and for whatever the reasons are. Sometimes parts of the world that are kind of difficult to do business in, companies will want to withdraw from for whatever reason. We certainly saw this, companies fleeing Russia in the last few years, mostly as a result of Russia's involvement in Ukraine. And so those would represent discontinued operations. And I think I just saw something on TV about the McDonald's franchises have a different name, but they still are selling McDonald's products and whatnot because McDonald's, I think, pulled out altogether or mostly pulled out. In other words, discontinued operations. And so, so if a company decides to get rid of part of their business, then you have to recognize and report that the effects of that discontinued operations, which we'll get to in a second. Disposal is what we call a strategic shift. Strategic management is simply this big picture view of what we're doing, why we're doing it, what's our identity, all these kinds of things. And so in this case, we've got, let's start with the section of the income statement. There's income from continuing operations. This is before tax. And then there's a tax expense on that, which we're saying is 25%. In reality, C Corps in the US are paying 21%, but let's not get hung up on that. Income from continuing operations, okay? So far, so good. And then we have income from discontinued operations, 200, I don't know how many zeros we're cutting out here, net of 58 tax expense, and so it's 150. And so as a result, net income is actually higher. There is actually income from the discontinued operation. And we'll talk about the timing of this recognition and how it differs depending upon when it happens and how we do the reporting. And so this leads us to this next topic. When the component has been sold, whatever it is, a business line, a division, a subsidiary, whatever, and if it's sold before the end of the reporting period, you're going to obviously you're going to bring current the income or loss from that particular activity up to the disposal date. And then any kind of gain or loss on disposal of the company's assets, if there is. So this is more of an operating item, and this is a non-operating item. But it's bringing these things current as of the date of the disposition, which is probably the more common feature, but it's not exclusively the only type of situation that might happen because sometimes they haven't yet to be sold, but they've been declared as being discontinued. We'll look at that in a second. So here's an example of Duluth Holding Company. This is a hypothetical example. Decided to sell one of its divisions. It qualifies as a separate component, okay, and according to GAAP. And so from January the 1st to disposal, we had a pre-tax loss of $5 million, but then the assets had a selling price of $15 million against a book value of $12 million, so we have a gain. So the gain partially offsets the loss, and so instead of a $5 million loss, it's a $3 million loss once we include the gain from the sale of the assets. So we have a $2 million loss. The income tax benefit is going to be $500,000. That's 25% of $2 million, okay? And what this looks like is a little bit beyond where I think we want to go. It may or may not be the case that the company could take that benefit in the year in which it's incurred or experienced. And so we just don't know enough information about that to know. Sometimes we create what we call a deferred tax asset. In this case, that we're going to take the benefit later down the road. Doesn't really matter. I don't want to I don't really like to get too far off into the tax issues because they're complicated, and particularly when we start bringing in foreign international taxes, it really becomes complicated. But nonetheless, here's the idea. The action reduces the loss from that to $1.5 million. And so as a result, 20 million minus 1.5 million gives us a net income, which is the bottom line, including income from continuing operations as well as the income or loss from the discontinued operations. And that sort of includes those losses incurred, actually it was the gain incurred by leaving and disposing of the asset. Okay. And then, okay, so that was an issue where we had sold the activity, whatever it was, whether it's division, subsidiary, product line, region, whatever the case might be. But what if now the component's being held for sale and we know we're going to discontinue it? The board has said we are going to discontinue it. We're going to bring this all the way to the end of the accounting period and report as we ordinarily would, income or loss from operations, but we're going to separate it out from continuing operations because we know this particular element, whatever the component is, division, subsidiary, whatever, it's going to be going away. And then if there's an impairment loss, if the book value of the assets is more than the fair value, again, fair value or fair market value is what it might be worth in an arm's length transaction, then that would be the accounting treatment. Now, there's a test for impairment that we're not going to get into here, which is different than this calculation, right? And when it has to do with future cash flows. And by the way, it's a different test in the FASB guidelines from the IASB guidelines. It's a little bit different. It's not hugely different, but if we're talking about big dollar amounts, it could be pretty significant. But if it turns out that there's an impairment that's been incurred, then we have to record the loss. And the loss is going to be this difference between the book value, which is simply an accounting record, the amount that we're carrying on the books versus what it actually is worth, minus any cost to sell, because disposing of assets oftentimes involves certain transaction costs involving third parties or fourth parties or whomever, right? So that's what an impairment is. An impairment is simply when management recognizes that something is impeding the ability of the asset to perform as it would. And I know just as an example in my own career, I had a client that had a number of gas stations, and I think inherited it from his father, who inherited it from his father, and these were really old underground storage tanks, and the government was really cracking down on underground storage tanks, and he decided he would just pull out of the gasoline business and just sell tires, which actually was a higher margin business than gasoline, but he had a pretty significant impairment loss because the asset itself had really was a significantly deteriorated asset on the books, and so but it made sense to do. But you get this idea that impairments are due to all kinds of things, and it could be that, frankly, it could be that sometimes the company's overpaid for an asset, and that's not a great thing. It's kind of an embarrassing thing, but sometimes companies do that, and it turns out if they've overpaid, and we know that and how do we know that they overpaid us? Because the asset is not performing as it should have or was expected to, and so as a result, we would recognize an impairment. Okay, and the test for impairment then is something that's done usually on an annual basis. I think both FASB and IASB require an annual test. And in a lot of cases, these long-term assets, it's obvious that there is no impairment. But in some cases, when it is, they have to report that and to take the expense that is associated with that. Okay. All right. This is the example of the company that well, we didn't sell it yet, but we've declared that we have a disposition going on. So we had a pre-tax loss from operations of $5 million. Assets had a book value of $12 million versus anticipated cost to sell of $9 million. So you had a loss there of $3 million. So together, an operating loss and a non-operating loss of $8 million. And so the income tax benefits 25% of that, which is $2 million. So as a result, that lowers the amount of loss that would have been the case simply because of the income tax benefit of that. Remember, losses are deductible events, and so they sort of move the tax needle in the other direction. And you might think, oh, that's great. Except, well, yes, it's great, but you've got a loss. And so I think a lot of times people get the idea that we want to sort of maybe take losses in order to reduce the tax liability. And I'm not saying that there are never instances in which that might make sense, but there is nonetheless a loss. It's a reality, and you usually don't get to your objectives by incurring losses. Okay? All right, this example here of sort of breaking these out, these are separately stated items, and so this is the example of Abbott Labs. This is obviously a real company, and what we've got going on here, this is obviously one of the notes in the statement where we have trade receivables and we have inventories, then we have current assets held for disposition. In other words, we're sort of breaking these out. What are they? We don't know. We can dig into the notes and find out. There'd be some written commentary that would explain that, and also current liabilities held for disposition that may or may not be directly related to the current assets. These are maybe all presented. There may be several activities that are earmarked for disposition. We wouldn't know until we drill down into them. But the point of this particular illustration is to show that these items are separately stated, and we want to make sure that we reflect the separate statement on those. Okay. All right. With discontinued operations, we have an example here: American Medical Inc. adopted a plan to discontinue one of its divisions, and it does qualify as a separate components, and so it's easy to separate out. And we have the entity concept. And so the disposal is expected to be concluded by March 30th of 2022. Okay, so it hasn't happened yet. And as of 2021, year end, the following information was there. And so the question is, what is the correct amount of loss here in this case? So we have 195 million, and the excess of book value or fair value, that would essentially be the impairment loss. And in the income statement, we reported for-tax loss of what? Well, it's 195 million plus the 25 billion, right? Except that these are broken out separately. This is an operating loss, an operating activity, a non-operating activity. And so they both will have the same effect added together on the very, very, very bottom line of the income statement, net income. But we break them out just so that users can know where the sources of those particular items come from. Continuing versus discontinued operations. And then when we talk about the tax effect here, we have an example of Triton Corp's results for the year ended December 31st include the following material items. We have sales, cost of goods sold, selling administrative expenses, gain on sales and non-operating, the loss on discontinued operations, restructuring costs. So what is the income from continuing operations, keyword here being continuing, before income taxes for the year? So we're not interested in the tax effect, we're just simply interested in the income from continuing operations. And here the math is pretty straightforward, right? Sales minus cost of goods sold minus selling administrative expenses plus the gain on sale, right? Even though it's a non-operating item, it's still a continuing operation, right? And then minus the $280,000 for restructuring costs. Again, it's unrelated to continuing operations, but it's nonetheless it's related to it in the sense that it takes place in this particular period. And so as a result, we have 1,420,000, and so that's the answer to that question. Okay. The discontinued operations would not be a factor here because it's not part of continuing operations. The restructuring costs would be, and because the restructuring costs are going to be continuing as we go forward, because they relate to continuing assets as we go forward. So again, there's always an interplay between the balance sheet and income statement, and I think this is something we try to emphasize a lot, is the idea that if something happens on the income statement, it's going to be reflected in the balance sheet somehow. And vice versa when it comes to issues regarding the balance sheet and its effect on the income statement. Those are, again, the two most important statements in financial accounting, and so those are things to be reconciled. Okay, just a little bit more that we're going to do, and we'll sort of end our discussion here and come back, and we'll pick this back up with some issues concerning things like earnings per share and whatnot. And then we'll get into comprehensive income issues next week. So when we talk about accounting changes, these are things where accountants have got to go back or not go back, depending on what the issue is. But there's something that is not correct. And an error is one thing. It's, who knows what an error could be. It could be an omission of something where the accounting staff forgot to include something or didn't think it was something to be reported when in fact it was. There was an error in interpretation of accounting laws, right? And accounting rules. And they're not always straightforward. And so that's one thing. But in general, you've got these three different categories. A change in principle, which may be something like, okay, we're going to go from a FIFO system to a LIFO or vice versa, or we're going to go from the gross profit method to the retail method when it comes to inventory. Whatever. These are things that relate to how we apply accounting rules. And so that's one issue there. And we'll talk about what we might have to do, whether it's mandated on the company by FASB or not mandated. Also change in estimates. estimate changes happen all the time, and they can be due to things like bad debt expenses, either over or underestimated. So we want to change our estimate on those. There are a lot of guesses that are made, hopefully educated guesses, as to things like what is bad debt expense looking like. What are things like things like depreciation expense, the estimated useful life of assets. Assets sometimes don't live as long as we thought they would at the outset, so we have to do a change in an estimate and bring that current. Oftentimes we don't have to go back. Usually we don't have to go back and restate financials, but just simply going forward from there. And we call that prospective accounting changes. And also things like reporting entity. All that really is the idea of who's doing the reporting and all that. And that's not something we're going to get into very much here. But we do want to talk about a change in accounting principle. And when we talk about these ideas of what is going to be required, there's something called a retrospective approach. And typically these are things that are what we say are mandated by FASB, by the government, by whomever, where the company has to go back and actually restate financial statements. It's not unheard of. It's not an everyday occurrence. It's something companies don't want to do, and in fact, it sort of is kind of a bad sign if you have to go back and restate financials, because I can tell you the financial community sometimes, particularly if it's a pretty material change, they sometimes say, "Do you really know what you're doing, or are you trying to mislead us?" And and I hate to put it that way, but that's kind of the way people in that world do look at it. So retrospective approach means we have to go back and change statements and do restatements of financials. It's not something, it's not a positive occurrence at all. A modified retrospective approach is, all right, just change what we're doing now, and then as we go forward, we'll kind of deal with it. And then perspective is, as we go forward, we'll change these. And so obviously, as you go down the list here, it's less severe, but obviously the retrospective is not good. But there are voluntary changes. Those are the mandated changes that might be imposed on a company, from outside, from authorities. The voluntary changes are things that companies do, somewhat frequently. One of those might be changing an inventory method for whatever reason. And I don't want to make that sound like it's something that companies just go in and out, in and out, in and out, between fine for life, 1 year and all that. But there could be reasons why a company would want to do that and make some changes, particularly as maybe a new line of inventory comes on board where we say, okay, we don't want to value these life, but we want to value these FIFO or whatever. And that may be simply something that needs to be illustrated and changed. And if it makes sense, companies will do that. We're going to get to all the issues concerning inventory a bit later, and certainly. Inventory is obviously a big topic in intermediate accounting. We talk a lot about it, different methods and different costing methods. It's one of the more challenging areas that my experience as students find a bit challenging, but we'll get there. We're not quite there yet. And then also, I mentioned earlier, changes in depreciation methods. Depreciation, depletion, amortization, sometimes called DDA. These are simply areas where we say, okay, we need to make a change here because something's happened that makes us necessitate the change. Our estimates were overly optimistic, overly pessimistic, whatever the case might be, and so we're going to change the method. It's a prospective thing. It means just as we go forward, we're going to be making these changes, and it's basically just an estimate, and that's really going on. And so it's not always necessarily changing accounting principle. That is, we're applying different rules to the event. We're simply saying the facts have changed, and we need to make a different change. If we own a fleet of 18-wheelers and we're driving way more miles than we thought we ever would, maybe we're using the units of production method, and we say, you know what, these trucks are wearing out a lot faster than what we thought. Then maybe we need to make a change to the depreciation based upon that. And when it comes to amortization, again, I mentioned last time, depreciation is really a form of amortization, but it refers to physical, tangible assets that are being depreciated, where amortization can apply to anything tangible or intangible, and it's used in a lot of different contexts, including, the writing down of a bond premium or discount, for instance, or even a loan balance. It's amortization. Depletion refers to extractive industries. We're not going to be covering that so much here, but it's just a means by which an asset is being written down over time. Okay. Counterflow prospectively is simply if it's material, a note is needed to describe the change. And notes are generally important here so that users can really understand what's going on and why these things happen. I can tell you that sometimes, as a young credit analyst, I was trying to figure out how to reconcile statements from one period to the other, and things sometimes didn't make sense, and the notes really weren't very clear. And we sometimes have to call the accountants and find out what the heck happened. And if it's one of the statements that don't require, just because of the nature of the statements, lots of disclosure, then you've got to do some digging. But I know that people would want to know what those are. Also, things like future warranty expenses, that's another estimate, right? Where it's really not known, but it's an educated guess as to what our warranty costs are going to be going forward. It's oftentimes informed, like bad debt expense, it's informed by past experience and with an eye toward what may be changing from as we go into the future. But those are often things that have to be revised as time goes on. And those are things that are oftentimes are not overly material, but nonetheless have to be reflected. Okay. And then errors are simply errors. There's not much really to say about this. If there's an error, it may require a restatement. And and certainly you're going to have to make some sort of adjustment in the books for that. And you'll often do if it's material. And there are some rules about material changes, and FASB has developed some of these rules for when something is material and therefore requires a PPA, a prior period adjustment. Obviously, companies don't want to do that, but it does happen. And there are errors that do happen. They just simply do. And particularly when you got very complicated operations and where the initial estimates are wrong or whatever. I mean, it is not as straightforward as what you might think. And I know this is something that's maybe a little unsettling to people when we look at accounting information. We see these numbers that look like they're etched in stone, that they were carried down, from on high. But sometimes a lot of these are estimates, and sometimes the changes are in fact material, and we have to go back and restate. And that's something obviously that's not good. There often are going to be balance sheet effects as well as income statement effects. And if there are income statement effects, it's going to affect retained earnings, which again, we get back to this interplay between the income statement and balance sheet. And when it's a material error that has happened, sometimes it's just something that wasn't really included because, accounting didn't feel that it was important to report, or that we weren't required to report it, or whatever the case might be. And so therefore, sometimes these things are necessary simply because of a lack of understanding or lack of awareness as to what the underlying facts are and how the accounting rules apply to them. Okay. All right. Well, I think that's a pretty good place to stop, because we're going to pick up with earnings per share. And as we sort of move down the income statement, earnings per share and that whole issue of stock valuation and how earnings affect the value of stock is something we'll get to a bit more next week and talk more about that. We'll also then get into comprehensive income. Then before the week is out, in week 5, our first exam, we will finish up talking about the statement of cash flows, which is an important statement, and it's one that we really didn't cover very much in Principles 1, and it's something that we do want to focus on here. Okay. All right. Well, hopefully everyone is benefiting from this. So if you have questions about anything, I hope you will feel free to reach out to me, and I will see you all next week.